And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Amid the FTX debacle and chaos in crypto trading this week, one fact has stood out. Bitcoin futures ETFs, including the largest, the ProShares Bitcoin Strategy ETF, BITO is the symbol, saw record trading volume, operated smoothly, and it operated in a regulated market. That's the futures market. Let's talk to the man in charge of that ETF. Simeon Hyman is ProShares Global Investment Strategist. Also joining us, Deborah Fuhr, founder and managing partner of ETFG, and one of the world's foremost ETF authorities. Simeon, lack of regulation over FTX is just driving everybody crazy at this point. But we did have one thing that really stood out to me. We have an entity that traded Bitcoin futures in the futures market, record volume. This is your product, operated efficiently. The prices collapsed, but if you wanted to get in or out at any one time, you were able to do that.
Absolutely. So we have BITO, which is the long Bitcoin strategy ETF using Bitcoin futures. We also have BITI on the short side. Both saw tons of volume. Both traded well, spreads tight in a tumultuous market.
Yeah. And you know what's amazing to me, Deborah, is regardless of the debate on what crypto assets are worth, and some people argue they're not worth anything, and this is a stunning collapse, the ETF market functioned fine here. Another example of really high stress, and the ETF market functioned as it was supposed to.
Yeah, and that's not surprising, because think back to the time of COVID and high volatility. People thought fixed income ETFs weren't going to work, and they did, right? So the ETF wrapper works really well.
And why does it work so well? What makes it so efficient? You know, people say that about the bond market. You know, you have these specialty bond offerings. Bond, any kind of banknotes, for example, or various offerings of limited bond trades that were available. And the minute the market gets panicky, the underlyings are not going to be able to trade, and the ETF will freeze up. And it turns out that wasn't true. None of that is true. Right. Actually, the ETF was the price leader over the underlying. That seems to be the real brilliant insight here that we've gained from the ETF business.
So I think it goes back to there is a whole ecosystem, and ETFs are highly regulated, right? They're funds that have the added benefit of being listed and traded on exchange. So what's inside of it is highly regulated, and then the authorized participants, the market makers, the trading desk all work together to make sure they work. And they go out and find prices. So that's what happened during the fixed income volatility during COVID. The APs go out and find real-time prices to be able to trade, and that's why ETFs were more efficient in pricing than mutual funds.
Yeah, and remember also, you in a lot of cases, you're not trading the underlyings, you're just trading the ETF as a product. That's exactly an important way to look at it. So there was enormous pressure on the SEC and on Gensler, Gary Gensler, and on his predecessors to approve a Bitcoin ETF. He has not been willing to do that. He has said there are aspects of this that are unregulated still, particularly the exchanges. There's fraud and corruption charges out there. He's looking pretty good right now, at least in my opinion. I mean, he's stalling. It looks like it was the right thing to do at this point. What does it do for the chances of a Bitcoin ETF sometime in the future, and what have we learned about this?
Well, I think it is important, though, to look outside the U.S. So in Canada, we have spot Bitcoin, we have Ethereum, we have Ether, we have a bunch of products in Europe, in Brazil, and other markets, and they've all worked well, right? So I do think that the crypto market has moved on from the initial time back in 2013 when the twins wanted to launch a Bitcoin product, right? So I think that it probably would have worked well, but I think right now there's not an appetite to bring it forward, and I don't think during his commission we're likely to see a spot Bitcoin product.
Well, that's a good point. But what about her point? I mean, they've got this elsewhere. It seems to be working, even if the market's collapsing. Is there less regulation in Canada, more regulation? I mean,
well,
the Canadian authorities.
There's 2 points that I make. First, FTX, a special situation. But remember, the exchange system as a whole for Bitcoin and cryptocurrency is still not mature. You know, even if you don't have an FTX thing, there's still the issue of lack of segregation in any Bitcoin exchange in the event of bankruptcy. So there's still maturation that needs to happen there. The other thing that's really important is that the futures market itself has matured very quickly. So everybody wanted to talk about the roll costs when we launched BITO. You know what? They've come down 80%, and they're converging right to the textbook solution, which is this is a financial future. You don't have to store oil in tankers, so therefore the roll cost should equal short-term financing costs. By the way, BITO holds cash to be quote-unquote fully collateralized, and therefore the roll cost offset by the earnings on the cash, and we've been tracking spot Bitcoin very, very closely. So, there's little downside to the futures contract.
Right. Well, this is a very important point about, this is the problem with owning futures contracts. When you roll into them, the commodities have storage costs, you get hit with that, and you get decay over time holding the asset. But here, there's nothing to store. It's just an electronic ledger item, literally. So in
the futures are cash settled.
But is there actually a roll cost involved in this?
There is, but what the textbook says is that the roll cost should be right around that short-term near risk-free lending rate. That's the no arbitrage condition. And BITO is just it's not a levered strategy, so you hold enough cash such that the return should be approximately spot Bitcoin, and therefore that roll cost is offset by the earnings on the cash. And that's what we've been seeing this year as BITO has tracked spot Bitcoin very, very well.
Yeah. I want to distinguish, people ask me what's going on with FTX. I want to distinguish here between the blockchain concept, which I am very personally think has tremendous future, reduces financial friction, smart contracts, decentralized finance, I think have tremendous potential as a financial disruptor, as a technological disruptor. And what's going on here? There's really two other things going on. One is, what's the value of cryptocurrencies in general, which obviously, don't have intrinsic value, so go up and down dramatically. But the other is what's going on with FTX, which may or may not involve fraudulent activity. We don't know. But so there's very specific situation going on here that's confusing everybody. Would you agree with the idea, though, that this is definitely a ding on cryptocurrencies, but doesn't destroy the viability of the blockchain concept?
Oh, absolutely not. I mean, we're in the early stages. There's clearly going to be a period of maturation, but to your point, blockchain and DeFi is absolutely here to stay. And Bitcoin, it's either a feature or a bug, depending on your point of view, is the pure play. It doesn't have utility on the blockchain, but it's a store of value. And look, if you want to have the sort of extreme view of things, there's no gold standard for the dollar either anymore. So.
Yeah, well, yes. However, I would like to back the full faith and credit of the United States over the full faith and credit of Bitcoin, of which there is none as far as I'm aware, other than a belief system around it. Deborah, I'm wondering how this might affect crypto ETF flows. This is your data. At the end of October, 162 products listed globally, 7.5 billion. This is crypto products. Are we going to see that change, or does this change this?
I think people are concerned, but I think you're right. We have to differentiate crypto products from the blockchain and smart contracts, because we are seeing that being used for many things, including tokenizing private equity and allowing retail access, right? There's a project in Europe where creations and redemptions for ETFs are being done by ETP Link using smart contracts, where before they were being used using emails. So I think there are definitely applications, and the technology is very different than crypto.
Yeah. I want to go back to your point earlier about the fact that there are Bitcoin ETFs elsewhere. There's in Canada, for example. Yeah. How are the authorities handling it there? I mean, Gensler says, I need more control over exchanges. I have no regulatory authority. What is the status of the regulatory system there?
So basically, they went to the regulator in Canada and said the ETF wrapper is better than other ways of allowing investors to have access. And the regulator bought into that idea. And just like in fixed income, the crypto ETPs or ETFs in Canada have worked as well as they would if they were.
And they're regulated by
yes.
the Canadian authorities.
Yes.
And presumably they're regulated, so they operate under a set of rules and regulations, obviously.
Similar to 40 Act funds here. There's a set of regulations in Canada. Canada actually has had ETFs for 33 years. We've had it here for 30.
Yeah.
So Canada.
So is there some argument that could be made? I'm just trying to flip this on its head and say, well, look, it is operating over there. Nobody's going to necessarily protect anyone from price declines. I think the problem here that Gensler is afraid of, which makes sense, is if this thing collapses, if Bitcoin goes to $1,000 or $500, 5 years from now, somebody's going to haul those people in front of Congress saying, did you approve Bitcoin for grandma? Because this is essentially making it available to the masses. And whether or not it's tested as a real asset class, or should that be the standard? I don't know. And I think it's interesting you point out, Canadians are working on this. They're doing it.
I think the challenge is normally regulations in the U.S. are about disclosure, right? So you tell what type of disclosure needs to be available, and then people decide if they're going to invest, right? And that's the whole thing with FINRA talking about complex products. What is a complex product?
Well, I think with respect to Bitcoin and cryptocurrency, you know, what happens if Bitcoin goes to 1,000? The issue isn't so much that we have disclosure rules. People can lose money, and we have the ITI. You could take the short side. The question is, what stress would that put on the exchanges if you were invested in the stock market, in the Bitcoin exchange itself? And look, the money's coming out of the exchanges right now. People are worried about the commingling of assets, and they're going back to these cold wallets where I have my flash drive, but the ETF fixes a lot of that, particularly when it's belt and suspenders with the futures market.
Yeah. I want to turn to a different topic, Simeon, that ProShares is very involved in, and that is, and I get questions on this all the time, these incredible volumes in the ProShares long and short NASDAQ 100 and S&P 500 ETFs. It's an amazing business that you've got going here. Every day, I look at the heaviest volume ETFs by dollar value and just sheer volume, and these show up every time. ProShares Ultra Pro QQQ, here we're listing them here. This is 3 times leverage, the first one, and the Ultra Pro Short QQQ, the ProShares Ultra Pro Short QQQ. So these are amazing. The Ultra Short Pro QQQ is 3 times inverse. Ultra Short QQQ QID, they don't have the symbols here, it's 2 times the inverse. The Short S&P, which is SH, is just a simple inverse. Every day, they have the biggest volumes here. And we've talked often about these leverage and inverse products, how they reset every day, how retail investors should be careful. Can you tell us a little bit, who's using these products exactly? I mean, the volume is so titanic that I want to see a use case for this. We tell retail investors probably shouldn't do this and hold them for long periods of time, but somebody's trading these things like crazy.
Well, there are a range of uses. We always talk about this. We're super proud to offer the toolkit to investors, both sides of the trade, depending on your point of view. I think when you look at a volatile market like this, one of the things that I'm sure that you notice is the divergence of views. This is a time when there's some people who think this is, they see the CPI print and they think that's only the beginning of the bull run, and then there's some other folks that say, man, I'm gonna sell this after this rally. So I think that divergence of views prompts folks to use these tools at a little more volume. And even in this environment, there are uses that are particular to right now and this time of year. As an example, tax loss harvesting. What if I'm about to harvest some losses on my high-flying tech fund? Well, I go harvest the losses. I can use a ProShares long QQQQ, and I can have my exposure to the end of the year and figure things out later.
Maybe, yeah. I guess you know what I would like to do? I'd like to bring some big active traders on and show how they use this, because there's got to be some relationship between, say, owning a sector like the NASDAQ 100, owning options and having different positions. There's a clear trading vehicle that's possible here, and I would like to see a clear use case, because the volume is so big that this isn't just a bunch of retail people, suddenly deciding they want to own GameStop on a day when GameStop's up 3%. This is very systematic, and there's some kind of trading methodology that exists, and I understand why some people don't want to tell us about it, but it's very obvious.
But also simply the fact that we forget the democratization is important, but also the fact that it's efficient. Even folks who could replicate that using the underlying instruments can often find our vehicles to be very efficient, and of course they trade all day long in tight spreads, so that makes it efficient for a wide range of folks. I
try to get this out of him every time I bring him on, and he always just talks to me about the diversity of people using the place. Okay, so we have often talked about, I call it the increased complexification of the ETF structure. I'm a Jack Bogle guy. I loved ETFs because indexing, it made indexing possible for the masses. Indexing was the important thing that came first, that understanding back in the 70s, and then in the early 90s, we started getting a way to get those indexes through ETFs. So that's why I like ETFs. Lower cost, tax benefits, just better for the average investor. But things have been getting increasingly complex. As the industry has matured, they're looking for other sources of revenue. So ProShares has been the leader in leveraged and inverse ETFs. You can argue, do I need 3 times leveraged S&P or triple Qs? Does the world really need that? Well, he's made a pretty good business out of doing that. Does the world really need 3 times leveraged oil funds? I don't think so, but there are people who think they can make a business out of it. I don't know. Should we prevent that from happening? What would be the criteria if it was some kind of threat to the system, for example, if it was a systemic threat? I don't know. Is there a standard that we should use about complexification of ETFs? And single stock ETFs, another example.
I mean, it's a great question. So FINRA did a consultation back in May to figure out how they should look at complex products. They want to think about how they should be defined. Should there be sales practices? Should investors have to attest to understanding the product before they buy? Should they have to have a certain level of assets? So right now, that consultation is ongoing. I heard the head of FINRA speak recently, and he said likely if they were going to move forward and do something, they would not specify exactly what they are, but there would be probably 3 more consultations before something was passed. So I think it is an ongoing issue that many of the regulators want to define this.
What complexification is?
Well, what a complex product is.
Should we separate, say, leverage and inverse products from regular ETFs? Into a different product category?
Yeah, many think that should happen. I mean, in Hong Kong, they are different, so they don't call them ETFs, they call them LNI products. So regulators around the world have different views on many types of products.
How would you feel about that? Should there be a different asset class? Is it not an asset class? Should it be a different category? Yeah.
We're a disclosure-based system. There are lots of things and lots of ETFs and mutual funds. We were just talking about bond ETFs. Many of them use derivatives to get their positions. So, disclosure is an important way to go.
That's another standard Simeon line that I keep getting. Despite stock, I love him. He stares at me. We get the same answer. Despite stocks down 20% this year, let me turn to you as our ETF expert. And bonds are down. The U.S. ETF industry, folks, you know this. It keeps raking in assets. It never loses. We have 3,000 ETFs now in the United States. 3,000. Right. We have assets of $6.3 trillion. This is Deborah's numbers, by the way. And we have 266 providers. You know how I know that? Because they all write to me. Stop writing to me, please. It's remarkable. Now, it's not just mutual funds converting to ETFs. We still see that happening, but it still comes in.
Well, I think there was an interesting study that Charles Schwab did where they said that 15% of investors in the stock market a year ago were new investors. So you're seeing new people come into the market. I think many because of your show, right? During the pandemic, most people were watching CNBC.
Yeah.
What's going up or down? And you were showing ETFs, right? People became familiar with them, were putting money into them. I think the other driver is as people get close to retirement, and about 10,000 people do that every day in the US, they look at how they should be investing going forward. They go to robos. They usually don't put their money into the robo, but they use that to become familiar with ETFs, asset allocation, low cost. Then they call an advisor and invest money, typically in ETFs. So I think there's a number of drivers, but the biggest driver has been institutions using ETFs. If you look around the world, many countries will tell their pension funds, when you want exposure outside of our own country, Mexico, Chile, Peru, Brazil, invest in ETFs because they're low cost, easy to use, easy to get in and out of, and that's been a real driver for assets globally.
I've seen that, Simeon, with the RIA business. I go to these conferences, and you've got a lot of guys who are quitting Morgan Stanley and setting up their own shop, and they want to find the most efficient way to set up shop and keep the costs as low as possible. If you want to get below 100 basis points on a client, that's not easy to do, but you can theoretically pull that in, and there's a lot of RIAs, they want 100 basis points. They want to charge. They don't want to charge 200 basis points, and they use ETFs. So the structure makes complete sense to me, and I'm not surprised that this keeps happening.
No, if you go back, 10 or 15 years, and you were talking to an RIA, financial advisor, and you'd ask the question, "Are you using ETFs?" we don't ask that question anymore. It's not a question. Everybody has converted their book to, if not entirely, but directionally towards ETF.
Let me ask you about your biggest asset, or your single biggest holding, which is Noble, the S&P, NOBL is the symbol, folks, which is the S&P Dividend Aristocrats Index, I guess you would call it. This tracks a basket of companies that are increasing their dividend year after year. Why is this the best strategy to own dividends and not just let's buy something that has the highest dividend yielding companies?
It's an elegant strategy because all you got to do is look for the companies that have consistently grown their dividends, and Noble tracks the S&P 500 Dividend Aristocrats. That's 25 years in a row. And I'll give you two reasons. One, because the dividends grow, which sounds tautological, but that's the key. It is the quintessential inflation hedge. Those dividends have been growing 12 to 14% a year since the inception of that index. Number two is the high quality. If you look at Q3 earnings, they were non-disastrous. Top line S&P 11%, bottom line 3%. Noble's index, top line 17, bottom line 26. They are delivering margin expansion in an inflationary environment because they got pricing power. That's a big 1-2 punch, and that's why they've attracted a lot of assets.
Yeah, and I keep explaining this. Like, people say, the S&P has a less than 2% dividend yield. Who cares? I said, let me tell you something. Historically, there is a big difference between a company that has a 1.5% dividend yield and a 2.5%. over many, many years. Bogle used to do this in his books, say this is 1.5% difference in a return over 30 years. When you start getting into hundreds of thousands of dollars, you get into the beauty of compounded interest, which is the greatest invention in the history of the world, which is that in the early days, it doesn't look like anything. And then when you get older, all of a sudden you're 65 or 70 years old, and that difference is enormous. And it's this is a simple way I explain it to people. The other is people say, give us the highest dividends. You know, I want to buy the top, 5 dividend. I said, those are not safe. A company that's paying you 9% dividend yield right now is probably in a somewhat precarious position. You better be real careful.
And even if it's 5 and it doesn't grow, you know what it is? It's a fixed coupon bond, totally exposed to inflation and any residual increase in rising rates we might see.
Yeah, it's a good point. I know we've wandered around a little bit here today, but we've got two experts on big topics. So that's why we have the best people here from the ETF business, folks. That does it for this week's ETF Edge. My thanks to Deborah and Simeon. We've asked Simeon to stick around and chat a bit more about trends in ETFs he's seen for the end of the year. That's for the ETF Edge podcast. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.